Okay, so hello everybody. The purpose of this discussion is to prepare you for Chapter 3 and to prepare you for understanding the most critical concept in Chapter 3, which is a concept known as accrual. So, I want to give you a brief example of how accrual works so that we can understand it when we get into more detail about it in Chapter 3. And in our example, we're going to talk about starting a lawn mowing service. Now, you have printed out a list of transactions for the lawn mowing service. You also have a transaction analysis sheet. What I'd like you to do is follow along with the list of transactions, and I'd like you please to enter the transactions onto your analysis sheet because you're going to use them for an assignment I'm going to give you. So let's look at each transaction one by one. On May 23rd, you start your business with $5 in your pocket, which you contribute to the business. So this one's easy. May 23rd, transaction is contribute money. And you know that the cash account increases by $5, that's an asset, and the contributed capital account, which is an owner's equity account, also increases by $5. And we've got our company started now with assets and owner's equity equal to $5. So we're on our way. On May 24th, you borrow your uncle's mower and you buy $5 worth of gasoline. Now, borrowing your uncle's mower, you're going to borrow it, you're going to give it back. It doesn't really involve any money, so we don't really need to analyze that transaction in terms of accounts, which keep track of monetary value of accounts because there's no particular monetary value here. So for the for the May 4th activity, all we're really concerned about is the $5 we spent on gas. So May 24th, bought gasoline. So now we subtract $5 from the cash account, and we have gasoline supplies, if you like, gasoline supplies. That is an other asset, and we're going to add $5 to that account. So we balance. One asset, cash, is reduced by $5. The other asset is increased by $5. All right. And now on May 25th, you mow a lawn. And you charge $50 for mowing the lawn. But there's a catch. And the catch is this. Your customer asks if your customer can pay you sometime in June. The customer basically wants to have an account with you, so the customer wants to pay you the cash later. So you've mowed the lawn, but you're not getting cash. And since you're not getting cash, we can't increase the cash account, so instead we have an asset which we call accounts receivable. Now, that's an asset because it is money owed to us. So it is an asset, but it's not cash. It's an other asset account. So accounts receivable, the other asset, is increased by by $50, because that's what we've charged to mow the lawn. And you know what? We've mowed the lawn, so we have performed the service. We have earned our $50. We're just not going to get the cash until later. So we actually are going to claim the revenue now on May 25th. We're going to take the service revenue for mowing the lawn revenue, the service revenue account, and you know that's a revenue account, it's under retained earnings, we're going to increase it by $50. This is the critical concept. We have earned the $50. We have performed the service. Therefore, we claim the revenue now, even though we have not gotten the cash. We call this accrued revenue. Accrued revenue is revenue we have earned before we actually get the cash. So we have the revenue on May 25th, but we won't get the cash until June. Now also on May 25th, we use the $5 worth of gas to mow the lawn. So what do we got? We've got gas supplies, the asset, which now is reduced by $5, the other asset account, because there's no gasoline left, and now we have gasoline expense. And gasoline expense is a retained earnings account, and now we know an expense always goes into retained earnings as a negative, so we have negative $5. And we are finished with May 25th. We mowed the lawn, we earned the revenue of $50, we incurred the expense of $5. So now, on June 5th, the customer pays us. We're through with May now. May is over. On June 5th, the customer pays. So now we have cash increased by $5, and we have the accounts receivable, which I'll abbreviate here, decreased, or cash increased by $50, and accounts receivable decreased by $50. And then, the next day we decide we hate mowing lawns, we want to go to the beach, and we close the business, and we're done. So, here's my question for you. Pause for a minute after I ask the question and ponder it. How much is the income for May? Now, some of you may want to say there is no income in May because we don't get the cash until June. But that's not right, because remember the definition of income. Income is revenue minus expenses. And even though we don't get the cash for the revenue, we have still earned the revenue in May. Therefore, we have income in May. Our income in May is going to be the revenue we have earned, regardless of cash, minus the expenses we've incurred. So, what's the important point here? The important point here is that income is different from cash. Our income in May was very different than our cash flow in May. So,